Welcome to PCBCast. Following the success of our pilot episode last year, we're now beginning a series for 2024, starting with a review of last year, 2023, and our thoughts about what we see as lying ahead. And joining me today are Harry Martin and Cameron Kerr, both of JLL. Harry's a director at JLL and Cameron's a senior analyst. Thank you both very much for joining me today and sharing your thoughts, and I'll hand over to Harry to introduce himself.
No problem. Thanks for having us in. I'm Harry Martin. I'm one of the investment directors sitting out of our City of London office, returning from the UAE 4 or 5 years ago after a 5-year stint there. I've been predominantly focused on investment related residential stock in Zone 1 London for the past 4 or 5 years now, and slightly broader from there. So good to be here and good to share some thoughts.
And I'm Cameron Kerr. I've been working alongside Harry in the City sales team for the last 5 years, primarily new build stock across Zone 1 London on the investment and agency side, and been fortunate enough to work with you, Sam, on a few of those deals for over the last couple of years.
Brilliant. Thank you both again for being here. So starting with 2023 then, I can't actually remember the last time we had a straightforward plain sailing year, and 2023 has been no disappointment in terms of challenges and interesting times. I think I mentioned in a recent newsletter. So what have you seen as the shifting dynamics in 2023 and what we might take away from it when we look back at it in the future?
Yeah, so look, I think, as you mentioned, 2023 was an interesting year and probably required a lot more focus and a shift between our more traditional approach to selling. And I think that the dynamic shift in buyer and sellers was really seen more so on the buying side. I think that there's obviously a money market that's outperforming a lot of our real estate yields in London right now, particularly Zone 1 London. So I've personally seen a little bit more of a shift towards the more emotional mindset with buying, whether that be something predominantly for self-use or owner-occupiers coming back to the market a little bit more than investment buyers in 2023. I think they're probably needing to be far more sharp and bullish on pricing, which isn't really presented itself, which as an overall view on the market is probably a good thing. It's been quite a resilient market. But the main shift for me has been seeing a little bit more of an uptake in that buyer type. I don't know about you, Cam.
Yeah, I think exactly that. It seems like a long time ago now that we were slightly reading from the mini budget and the predictions of double-digit price falls for the year. I think we didn't see that. It was more resilient than a lot of people forecasted, but we did see a drop-off in that investment buyer with higher costs of capital and uncertainty in the market. Yields were compressed to a point where it did make sense for money to move elsewhere, and so we have had to focus on that more emotionally led owner-occupier end user, which has seen a bit of shift in the stock, the patterns in what's selling compared to probably the previous 2 to 5 years.
And you hinted on it there, and there was a bit of a clue. It wasn't a deliberate pun, but in the word interesting. So interest rates obviously being the biggest news story going into 2023, and then halfway through it impacted again. And you mentioned, Cameron, about there was a lot of very doom and gloom forecasting, understandably, I think, given what's happening about prices and that kind of thing. And we haven't really seen it materialise, have we? I just to use a personal anecdote, the day I was having my valuation done on a house that I moved into in late 2022 was the day that I think the headline of the Times was prices will fall 15%. So it did help with a down valuation, which helped with the price negotiations. So I'm not complaining, but have we seen anything like that 15% drop in prices?
No, and I think we'll see the stats coming out of what we've landed on in the next couple of months with land registry data, but it looked like lower single digits. I think especially our market in Zone 1 London is more isolated to a big price fall. I think we're not counter-cyclical, but not as correlated as the rest of the UK market, with a buyer demographic less reliant on leveraging. I think the stats that came out last year that was across the UK market was that people who own their property outright is still the largest demographic, 32%, with 31% of buyers mortgaging. And of that mortgage buyer, the average loan to value is 40%. So although there is a lot of exposure in the wider and regional market, Zone 1 London, a lot of our buyers that we have dealt with over the past decade were taking leverage more as a bit of a luxury because it was historically cheap.
Almost free money.
Yeah. And a lot of those people could just buy out, redeem that mortgage rather than going through a remortgage at the higher rates. So we didn't see the distress caused by that for a lot of our owners. Do you think that probably rings true for most of our market?
Yeah, I do. I think, look, we're in a far more luxurious position in Zone 1 London than most, that we are, for point of a certain term, we're far more cash rich, I would say, with the buyer type that we're dealing with that aren't dependent on debt. So I don't think it had as much of a negative impact as we thought it would in pricing. That said, of course, it's going to play a factor on the short-term investment numbers when making that initial investment. I think we probably saw a slowdown in activity based on perception of the market, in a sense, rather than a real distress or need to sell. But look, interest rate rises, it's not making as much of an affordability issue here as perhaps it would across the country. I don't think we saw that spike that we were expecting.
And I think what this sounds like is that it's all in the detail. The devil's in the detail, the nuances of these things. It's never, as we all know, it's never as bad or as straightforward and blunt as headlines would have us want to believe. And once you actually get into the detail, there's a lot of dynamics going on there whereby the market continues, and I think what it really shows is the resilience of the property market generally, London especially, and we've seen it through the pandemic, we've seen it through Brexit, going back further. So this is just another challenge that we leapt over in 2023, wasn't it, really?
Yeah, I think so. And I think sellers, it almost forced sellers to sense check their investments, and it produced, some opportunity there. I think for investors coming in the last 6 to 9 months, there was certainly an opportunity just on the basis of sense checking portfolios that were originally held and have been currently held by perhaps more institutional or commercially minded investors. I think they've been able to release these at value. So look, there's opportunity in anything, but yeah, you're right. It's perception and where it ends up landing for these types of things, and I think we were fairly protected from it.
Yeah, I also think that with interest rates were historically low, it wasn't that they're now ridiculously high and it's a massive challenge how high they are. It's just an adjustment, which hopefully we've now been through. The goalposts have changed. Hopefully now they'll stay where they are for some time. And in actual fact, we'll get into 2024 in a bit, but there's been some good news on interest rates already this year. So I think once things stabilise and everyone adjusts to it, actually interest rates aren't high. They're just,
No.
I don't know if you could ever describe anything as normal these days, but they're probably where they should be. We've not really seen the price changes that were forecast and the doomsayers would have liked to have seen, probably. And I think, Cameron, when we were talking recently, you mentioned that there are actually some positive areas of the market that are moving well. I think the prime market, you were saying.
Yeah, and that's what was seen last year. This prime and super prime market has been one that's underperformed throughout the pandemic, where you saw regionally growth of close to 20% between 2018 and 2022. In some areas of the regions, you actually saw the super prime it remained below 2014 levels. It was an area that had struggled, and I think some of the political issues with the war in Ukraine and freezing of assets, and I don't think that helped some of that super prime market, but we've seen it bounce back very strongly, and transaction volumes and the money spent in super prime has now exceeded 2014 for the first time in close to a decade.
That's fantastic, and it feels like it's been long overdue with the super prime market. We probably all remember the days when the super prime market and the prime market of London was just the talk of the world, really, and everyone was investing, and everyone thought, could it ever go down? And of course it did, and it's been stagnant for such a long time. And I've been eagerly awaiting the return of that part of the market because perhaps I'll hand over to you, Harry. My impression is that kind of sets the bar because prices will fall into line according to that. So that kind of ceiling of that being so stagnant for so long is going to put the damper on prices. But once that starts to move again, which it sounds like from Cameron it is, then that should start to feed through to the rest of the market over the mid to longer term.
Historically, I think that's what we've seen. It's a huge confidence boost for the market to see the activity levels for prime where they're at. I think there's a return in focus from most other parts of the world that we've seen enter London over the last 15, 20 years want to come back. And I think fundamentally there's a massive undersupply of stock, and more specifically for ultra prime London, there's always going to be an undersupply of stock. And I think as soon as that money starts to move back into London, I would like to think that the peripherals of that market will return, and the city and the financial districts will start to see the same level of activity. It's definitely a positive, and we're definitely seeing that start to come to light. In respects to the global of it, look, I think the reality with London is we're always going to suffer somewhat from any sort of political uncertainty and the ability to freely move money or assets around within London and from overseas. And we've unfortunately seen that with the events over the course of the last 18 months. But again, going back to the resilience of the market and the stability here, I still see London as on a pedestal for most real estate investors as to where they would look to hold residential investment. It's a market that attracts from an educational perspective, whether that be our universities or colleges, or also from a financial district perspective in Europe. It's a market that's, I think, seen as an accessible and has easily tracked market. So I think we're always going to see the confidence return once Zone 1 does.
I think a lot of that's quite symptomatic actually of Britain generally. The strengths of Britain have been really taken for granted in recent years, I feel, and we are a very stable society. We're a very strong legal system, very safe haven to buy. The risk of if you buy somewhere like Spain, for example, then the Spanish government might repossess your property if they feel that they need the money. You don't have those kind of risks in the UK, and there's been a lot of bashing of the UK in the press in the last couple of years for obvious reasons, and it's not as though we haven't deserved some of it, but I think what's been lost in that is the underlying strength, and resilience is a word that keeps coming up, and stability. Even in a government where we've changed prime minister seemingly every 5 minutes, it's still been pretty stable. There hasn't been any outbreak of war, any real instability like you see in other countries. So I think Britain sometimes, and London especially, we have this benchmark of normalcy, which has just been ignored in recent years, but that's still there and still very much a strong reason to have London ranking highly in your investment approach. So I think before we move on to 2024, we should probably, again in the context of pricing, just touch upon the rental market and just get your thoughts on that and what we've seen, because it's been quite a remarkable time, I would say, in that area. Cameron, what have we been seeing in the last 12 months on that front?
I think it's been the story of London property has been how strong rents have been. So I think this month first, the annual growth dropped to 9.7, which was the first time it wasn't a double-digit annual growth for 19 months. I think halfway
Still quite high as well.
Still very strong in the summer market, which is traditionally the peak summer market for rents. I think the stat fell at about between 20 and 30 rental applicants for every listing. I think the demand outstrips supply by such a level, and I think they are predicting that to slow somewhat and fall this year at between 6 and 7% annual growth, but has been incredibly strong over the last year. And although that was coupled with higher cost of capital and the interest rates we touched on, I think as they start to come down, that dynamic for investors will start to look a lot more favourable, because a lot of that growth was offset with the higher cost of capital. It's going to be a better picture coming into this year. Last year, something we've discussed at length, but with the cost of capital, it was still 25% more expensive to buy than rent, and so I think that led into that rental demand, which might start to ease. So I think that will lead into healthy growth this year for the rental market.
So perhaps starting to see some more stability, like we've talked about with interest rates, and hopefully some more predictable trading conditions, perhaps.
Yeah.
We'll see. Excellent. So just to wrap up 2023, and I'll throw this out to whoever wants to take it. What surprised you most about the London property market in 2023?
I think a number of things, but on a more positive note, I still think it was surprising how resilient, I know we've used this word a few times, but how resilient the market actually was. And I think there was still a lot of activity and desire to want to buy in London. I think one of the surprises that maybe caught me off guard a little bit was there were some legislation changes across the industry, particularly in residential conveyancing. And Sam, you'll be more than aware and equipped for this, but there were changes to fire safety regulations, cladding and requirements of landlord certificates that I think, to be honest, gave a bit of a misrepresentation of where the market was. I think the length that perhaps some of these updated processes have taken have maybe given the market a bit of a hangover and maybe caused buyers a lot of frustrations. I think the timing of getting these particular deals through has been a bit unexpected. It's probably something for another day, but I think that was a surprise, because I was surprised that the want to buy, perhaps the need to buy for a lot of investors and buyers out there, but the ability to get it through based on those processes was probably a little bit difficult, and more difficult than I'd imagined. So that was one of my surprises. But again, it's going back to the fact that there wanted to be a market there in London, and perhaps there's just a few of these things that we need to iron out to really get there.
I think surprised and disappointed probably on that front, because it's something that has needed clarity, and since the tragic events at Grenfell, there has been an impact on the property market and the process really, and what's required. And what we were really looking for from this legislation was some clarity to remove some of that opaqueness and also streamline the process, and we were perhaps naively hoping for. And I remember, Harry, actually having a conversation with you a couple of years ago, and we were getting quite excited about when this is resolved, that underlying groundswell of pent-up demand that's an activity that's there waiting to happen. And I think probably both of us were hoping it would be as a result of this legislation. It hasn't, but it's what you're saying is it is still there, and when it does start to come through, we're going to be in a really strong, busy market with years of pent-up demand.
Yeah, I think nail on the head is there is pent-up demand. I think there is definitely pent-up demand from both sellers and buyers' perspective in London. Look, we've been in a market where the ability to build hasn't really been there. Developers are looking at construction costs and perhaps cost of debt and finance to do this and deliver this. With where the sales market is, there's a lot of it that perhaps didn't quite make sense. And that's only going to lead to more of an undersupply in the residential markets, most definitely over the course of the next 3 to 5 years. And as we've seen historically, supply and demand is the simple calculation that really does drive our markets, aside from capital cost and everything else that we've discussed today. I think the real simple equation is that we haven't built enough, and that's only got worse. For me, I think it's quite exciting coming into the next 12 months and beyond, that from a new build perspective, we're gonna have a bit of a shortage of stock, and that may drive the markets for sellers and give us a bit of recovery going into the next 12 to 24 months.
And I think one of the things that the cladding issue has highlighted, and it's a very self-serving message, but is the importance of getting expert guidance when you're transacting in any market, but particularly the London property market. And I've always been really impressed with yourselves, and particularly Harry. You're very clued up on what's going on, even though it's very hard to follow at the moment, and always asking questions. As soon as legislation comes out, you're on the phone to myself and some of the other lawyers asking what does this actually mean. So just hands on the ground, actually getting to grips with these issues, and it's absolutely essential if you're going to be transacting in this marketplace, because if you don't do that, you may waste your time for weeks or maybe even months not getting anywhere and not knowing what's going on and realizing actually this wasn't going to happen for a particular reason. So it does really highlight the importance of working with people who know what they're doing. And am I being naive again in asking whether a change in the political situation this year with an election might usher in some better legislation? Probably. Whatever government we end up with, they have put property quite in focus. They've been working on leasehold reform, for example. So it's possible, if this continues to be such a difficult issue, that they address it again and maybe get it right this time. Who knows? I've got my fingers crossed for that anyway.
Yeah. We'd hope so, but yeah, no, it's hard to hang your hat on it now. But yeah, I think going back to the point of being clued up, I suppose we sit in a market in London where we are far more exposed to international buyers, and I think it's such an important point to know the challenges that come with buying. A lot of people are very quick to spell out the positives of buying in London, and it's important to be able to solve those problems when needed, especially for overseas buyers that perhaps don't have the same access on the ground as we do. Yeah, it's a real important point for us and the team to have that.
Yeah, I think whenever you're investing in a foreign country, there's always that added layers, I should say, of complexity of it being very foreign, it being an alien experience, and many of our clients and your clients it's not their first language even. So yeah, there's so much to get their head round. It's so important to have that proper expert guidance. And even we talked about at the beginning of the podcast about owner-occupiers. That owner-occupiers don't tend to transact in property regularly like other investors might. So it's a very alien experience for them too, and more emotional. So having that hand-holding is really such an important value add and can't really be underemphasized. We've summarized, or we've touched upon, a fair bit of 2024 and looking forward already. I don't know if there's anything more really to say about the mortgage market other than to reiterate that we hope it's now stabilised, and just to go into a bit more detail on that statistic that I mentioned earlier. So Halifax a couple of weeks ago announced having reduced their rates by 0.92%, so quite a large drop, and they triggered a bit of a price war. I haven't checked recently to see whether anyone is lower than Halifax at the moment, but what we are seeing is not only that stabilisation, but actually them coming down on not the base rate, but the retail rate. So that's definitely a positive sign, isn't it? Cameron, what are your thoughts on that?
Yeah, certainly. I think the higher rates have now been absorbed by the market, coming off historical lows. It was an adjustment for the market to make, but we work closely with Lifetime Capital, and on some of their 5-year deals, they're actually getting low fours, even one lower loan to value rate, a rate starting with a 3 on a 5-year fix. So we're certainly seeing, I think, the 5-year rates land at what will be close to the new normal. And over the last 50 years, the average mortgage rate has netted out to around 5%. So I think we will, if the base rate is forecasts to come down to 3.25, and the retail rate being mid threes, I think that's going to be a rate that and a level that can be easily absorbed by the market.
I'm actually just looking up to see if I can get some more fresh data on interest rates, and what you're saying, Cameron, is actually a slight improvement on the research I did a couple of weeks ago. So that's really promising. And I've actually just stumbled across a headline from the Times, the newspaper that predicted the 15% drop that I mentioned earlier. They're now swung the other way. UK house prices will defy gloomy predictions and rise this year. So that's today they've published that, which is, I'm not going to cherry pick the headlines that I like and don't like, so we'll take it with a pinch of salt. But it's good that the sentiment is changing, definitely, and hopefully that's the message for 2024. Is we had a tough year last year, and things can only get better. Harry,
I think so. Look, any good news story, and that is a good news story, right? Look, it's most clients buying in London were, I think, financially astute enough to know that the base rate was never going to remain that low forever. It's incredibly long periods have that cheap. Coming down sub 4% is definitely a positive in the market, and albeit with all the challenges, looking at some of the stats for last year, and just I think it really evidences how important that undersupply is. JLL, we traded on almost £3.2 billion worth of new home stock last year, with an average sale price of almost £925,000, and I think that tells you that there's a pent-up demand activity-wise from both the UK market and overseas to remain able to buy London. And I think this mortgage rate shift just betters those chances as we move into 2024. So tough and difficult year to navigate, but actually a lot of the stock that was delivered we've sold and we've done quite well on. That's why I'm quite confident going into the next few years, because I think ultimately, looking back now, looking behind us, looking in the rearview mirror, it probably seems to be that period of build and completion pipeline was probably at its worst then than it will be now. No, I'm looking forward to what the next couple of years will bring in the residential market.
it's definitely been a headwind over the market, hasn't it, in the new build sector of completed stock. I can cast my mind back a few years where lots of the exhibitions that PCB are involved with, it was for the same projects that had been out millions of times before, and I think one person described it as being like a second-hand clothes sale where everyone's already seen or got the clothes.
Yeah.
And it's clearing that completed stock has been something we've been looking forward to happening, and so it sounds like that's a trend that you.
I think we're seeing it. It's certainly coming down now. I mean, there is still remnant stock out. There is still, and I think there's still.
Well, there always will be.
Yeah, there will be, and I think clearing that market down is important. But we've certainly made inroads into that. And if you look at the couple of the new projects that have launched in the last year, they've done incredibly well. And are they at slightly different price points than we would have predicted 5 years ago? Probably, yeah, absolutely they are. But it doesn't downplay the activity and the appetite. And I don't think we're there yet to see that pre-pandemic boom. So, some of those exhibitions that we've done in Hong Kong and across Singapore with you, Sam, I don't think we're going back to that supply issue. I think that's due for a return, in my eyes anyway, because naturally the overseas investor have looked toward their own markets, particularly in the Middle East, where you've seen really high returns in their local market. I think that doesn't at all downplay, I think, the want to still buy London. And I purely think that it's been an accessibility issue. It's stock driven. So yeah, I'd agree with you. I think, look, we're moving towards the right direction of being able to deliver on the stock that was once promised.
I think that's a really good point, actually, with about people's local markets, because Singapore, that's been downtrodden for so long locally and in terms of buying overseas, their local market has been strong for the last couple of years, and Dubai at the moment, the local market is absolutely crazy. And what we tend to see is it starts there, and then maybe it takes a little bit away from London while that's happening, but then a bit like the super prime, to draw an analogy to that, it will then filter down into, okay, we've been investing in our local market. Maybe we'll continue to do that, but we're now ready to start investing outside of that as well. Our economies are more robust. We're in a good position for investment. Where are we going to look? And London tends to be the next place where people cast their eyes once they've sorted out their local setup. So that is a promising signal, actually. And also, yes, there have been exhibitions that have been less busy, and we don't see those tens and hundreds of deals over a course of a weekend. It's a lot more spread out, not just across the time span, but also geographically. You'll hear a fair bit more from PCB about Turkey this year, for example. There's lots of jurisdictions now that are investing that weren't really before. So I think it's spread wider and maybe more thinly, but overall the volume potential is there. What do you see as the emerging opportunities for this year, would you say?
I think ultimately the change in interest rate is going to carry through a positive narrative, I think, into the tail end of the year. And I think there'll be a slight return to the market from previous buyer types that can start to make the investment numbers make sense. So in my opinion, there's an opportunity in buying certainly earlier on into the year to try and find the value in the market, because I do think that London does work on a slightly different trajectory to the rest of the country. I don't think there's an affordability issue in London. I don't think that, going back to what Cameron said about the amount of buyers here that probably own their houses outright or own their property investment outright or with a large invested equity, we're never going to see that level of distress in regards to affordability to be forced to sell. So I think what you're seeing now is that build-up of remnant stock, especially in the markets that we're in or with more commercially led investors looking to diversify. There's an opportunity there to buy in the earlier half of the year. I've also started to see an opportunity in certain boroughs within London, notably the City of London, that are slightly more open to change of use from commercial space perhaps to co-living, which will be a positive for our market and ultimately produce more residential stock. And Cam, you can probably touch a bit more on that, and if we've seen anything that you think maybe would present itself as an opportunity.
Yeah, I think that change of use from commercial to living is an opportunity. I think that's driven by our supply constraints. We've talked about how we think the remnant stock will be cleared, and I think one of the challenges for buyers looking probably a little bit further ahead than 2024 into 25, 26 is supply constraint. It is one of the hangovers of the pandemic that we are seeing a lot fewer spades in the ground and a lot fewer new starts. Been a few reasons for it. We've had inflation on build costs. So build costs are now about 25% more expensive than the pre-pandemic. Increase in financing costs built into any development appraisal. We've also had regulation changes. So there have been 9 regulation changes since 2022, a lot surrounding the cladding and the fire safety regulations, but that's equated and been judged to equate to about 15% increase in costs. And then the construction capacity in the labour pool. So we're delivering at the moment about 60% of the required homes, and that just viability for developers coming into the market is going to really constrain the supply of new build stock, particularly in Zone 1.
It's interesting, isn't it? Because we've circled round and we're doing this review of last year and looking forward, and I suppose a high level view. And when you do take a step back and you look at the underlying structure of the markets, particularly the London property market, nothing has changed. There is this age-old dynamic of demand and supply, and the supply is not coming through fast enough, and the demand is still there, and the demand may fluctuate as we've seen last year and in other years, but ultimately the supply is going to be driving the fundamentals of the market, and that's what, as an investor and other types of buyer, you want to be thinking about, looking to the mid to long term. What does that mean? And it can only really mean one thing, can't it, Harry?
Yeah, I think so. Look, that's a great point. Has anything changed in London From an infrastructure perspective, certainly not. If anything, we've grown the infrastructure in London, especially from a transport perspective in the last few years. Have you always got a tenant? If we're talking residential, have you always got a tenant? Yes. Have you always got an exit? I would say yes to that. I think if it's an undersupplied market and you can't freely get what you want easily, I think it's a good starting point to invest. So I don't think anything's changed in London. There's the talk, obviously we talk about office space and how full we are, and does that have an impact on London? And of course it has an impact on every tier one economy, I'd say, across the world. And are we perhaps less tax efficient than we were 10 years ago? Maybe, but I still think that we're in line with most other safe, low risk economies in the world. And in my opinion, I still think the London real estate market is arguably one of the safest places to invest in the world, and history certainly tells us that. So no, I don't think anything's changed. I think the appetite will grow. I think it will grow, like you've mentioned as well, from other parts of the world, and other regions. I think can start to open up toward London investment. I think that we're in a prime position now to perhaps capitalise on the undersupply and start to see the market move where we thought it would.
So I'm just trying to sum up, and I think the word resilience kept coming up. I think stability, and with those fundamentals still very much solidly there and no signs of going anywhere, it's quite an encouraging picture. What advice would you both give to buyers and sellers entering the London market going into 2024?
I think with everything investment-wise or anything at this level of capital, I think speak to the right people. I think counsel is incredibly important, and even more so than it's ever been. I think having somebody on your side with knowledge and access to a market and to give you a real clear view on the positives and negatives important. So I think that's one thing I'd advise anyone coming to London. Find somebody that you can work with and that knows what they're talking about in the market you're looking to buy within. That would be the main one on advice, is that from me. Cam, what do you think from...
I think advice coming into this year would be, I do think there'll be a big opportunity for first movers in the market. Now that sentiment is changing, we'll always see with real estate a bit of delay between that market sentiment initially changing. You read that headline of the fact that predictions aren't looking as gloomy as they once were. There's always quite a delay between sentiment starting to shift and seeing those results in the land registry data. So for first movers to act in the first half of this year and capitalise on some of those deals before the sentiment shifts, I think there'll be a big advantage to that. And especially if you're, as Harry says, if you're speaking to the right people and have your team lined up correctly.
Excellent. So it sounds like we could be entering in a bit of a sweet spot where the sentiment's still not great, but the opportunities are coming and the market's turning. So excellent. How does anyone listening get in touch if they've got a property they want to list with JLL, or if they're looking for property to buy? What's the best way to get in touch?
Yeah, absolutely. Probably reaching out to if you're a secondary homeowner and you're looking to sell, I think the JLL residential website is the best place to go to find your local expert that can help you with valuations, buying or selling. And then obviously if you'd like to talk to either Cam or I in respects to investment, my best way of contact will be email. I'm harry.martin@jll.com, and I'd be happy to speak to anyone about post-investment advice or pre-investment advice and onward sales.
Excellent. And I'll share your contact details with the podcast.
Yeah.
Excellent. Thank you very much, gentlemen.
Thanks for having us.